In 2021, the housing market boomed because of low mortgage rates, low supply of homes, and everybody wanted to buy a home in the suburbs with an office in it. But what's really interesting is that when this housing boom was happening, nobody thought that we could even potentially be building a housing bubble. Every major financial news source reported how strong the housing market is and why this housing boom is robust and why it's not a housing bubble. It got to the point where some very influential experts even said that even if you start raising interest rates, it will not cool down the housing market and that housing prices will continue to soar. What was the reasoning? Well, they said this time it's different, which is why the home prices will continue to go up no matter what. Now here we are in the second half of 2022 and we're hearing a very different tone when it comes to the housing market. Now you have headlines saying that the housing market has entered a recession and the home prices have begun to fall, and these same experts are now predicting very bad news ahead. Let me start with this. What we're experiencing today is different than what we saw prior to the 2008 crash, and it's also different than what we saw prior to the 2000 dot-com bubble bursting. But while history doesn't exactly repeat itself, it does rhyme. We don't have the same ninja loans that we had prior to 2008. The ninja loans were the no income, no job, and no asset loans, where essentially you could walk into a bank and the bank would give you hundreds of thousands of dollars without any sort of income verification or any checks. We don't have the same subprime lending that we had prior to 2008, and we don't have the same adjustable rate mortgages today that we had prior to 2008, although adjustable rate mortgages are growing in popularity very quickly. What we do have today is a housing market bubble that has blown out of control thanks to the help of artificially low mortgage rates and a very low supply of homes. So people were buying homes because they said, who cares about the price? We can get a mortgage for 2.5%. This is what it was 12 months ago. You could go out and get a mortgage for under 3% for a 30-year fixed rate mortgage. So it didn't matter what the price was. So people were bidding up the prices of homes because one, there wasn't that many homes out there for sale, and two, even if you had to borrow another $100,000, it was still okay because you could borrow the money super cheap. So this environment caused the prices of homes to rise because now buyers were fighting against each other for the limited supply of homes. And then came the early part of 2022 when it became apparent to the Federal Reserve Bank that our economy is slowing down. When they realized that our economy is slowing down, and that inflation is still very high, that's when they started to change directions. Before 2022, the Federal Reserve Bank kept saying that inflation is going to magically go away and there's nothing that you need to be worried about with inflation and that our economy is very strong. Now what they're saying is, yeah, our economy is slowing down a little bit, but inflation is not going away and we need to get aggressive to fight inflation. How are they doing that? By raising interest rates. That's why mortgage rates today are past 6% many times for a 30-year fixed rate mortgage. Sometimes it does hover a little bit below it, but we have seen mortgage rates pass 6% for a 30-year fixed rate mortgage, which means that a mortgage today is more than 2 times as much as what it was 12 months ago. It's more than 2 times as much as where we were just in the beginning part of 2022. So where does that put us? Now if you want to go out and buy a home, not only do you have to borrow more dollars because home prices are significantly more expensive today than they were last year or 6 months ago, but at the same time, you also have to borrow the dollars at a much higher interest rate. So now you're borrowing more dollars, you're paying more money to borrow the dollars, your property taxes are higher because property taxes are assessed based off of the home value. So now when you're paying more money for the home, your property taxes are higher, your property insurance is higher because now you have to insure a more expensive home, which means home affordability has dropped to some of the lowest levels ever. So something has to break. Either people have to earn more money in order to be able to afford these higher priced homes, or home prices are going to have to come down because of the growth in mortgage rates. While at the same time, the Federal Reserve Bank keeps saying that they need to be aggressive in order to fight inflation, which means they're going to be aggressive to continually raise interest rates. Now, when the Federal Reserve Bank raises interest rates, this doesn't mean necessarily that the mortgage rate you have to pay is higher. It's indirectly going to affect mortgage rates. Because what the Federal Reserve Bank does is they change how much banks have to pay to borrow money. See, banks have to borrow money, and this is the wholesale rate at borrowing money. Now, when you go and borrow money from the bank, you pay the retail rate. The bank borrows money at a certain price, then they add a little bit of margin, and then that's the margin that the bank makes because now you pay the bank's profit. That's what the interest is. So now, when the Federal Reserve Bank raises interest rates aggressively, like they say that they're going to do, that squeezes the bank's margins. So what does that force banks to do? Well, that forces them to raise mortgage rates. So as mortgage rates continue to go up, it makes it more expensive for you to go out and buy a home, which then ultimately will have to cause some sort of break. Either it's going to break the housing market or it's going to succeed to break inflation. The Federal Reserve Bank is hoping that they're going to break inflation before they break the housing market, but we don't know what's going to happen until it happens. And until we see inflation come down significantly, according to the Federal Reserve Bank, that's 2%, which is a long ways away from where we are now. Until we see inflation come down significantly, then the Federal Reserve Bank is going to continue to raise interest rates to fight inflation. Now, will they change their mind at some point in the future? Maybe, but this is the environment that we're in right now, which is why now we are starting to see the break in the mortgage business. Now, we've been covering exactly what's going on in the housing market in Market Briefs, which is my free financial newsletter. If you haven't joined Market Briefs yet, what are you waiting for? It is a completely free resource that I created where every day my team is breaking down what's happening in the stock market, the real estate market, the crypto market, inflation, and the global economy into a fun, easy to read, and witty email. Even if you don't have any sort of financial background, I promise you that you're going to understand everything that's going on in the financial markets in 5 minutes or less every morning. And the best part is that it's free. So if you want to join Market Briefs for free, I'll put the link to how you can do it down in the description below. Now that people are less interested in going out and buying a home because it's so expensive, and they're less interested to refinance their mortgage because unless you need to, it doesn't make sense for you to refinance your mortgage at 6% today when you could have refinanced it for 3% a few months ago or 6 months ago or 9 months ago. So many people are just not interested in refinancing, which means that the mortgage lenders are hurting, which is why we've been seeing a number of mortgage lenders that overextended themselves in 2020 and 2021 now start to shut their doors, do layoffs, or even potentially go bankrupt because they had extended themselves too thin, thinking that the 2021 environment would never end. Now here we are today with a very different economic environment than where we were 12 months ago. So we're starting to see mortgage lenders get hurt. We're seeing real estate agents get hurt. We're seeing title companies get hurt. We're seeing contractors get hurt. And we're seeing real estate developers get hurt. So it's hurting the real estate industry. But the question is, how deep will it go? And this is ultimately going to come back to the Federal Reserve Bank and how aggressively that they're going to continue to raise interest rates, which brings me to the teeter-totter. This is the financial teeter-totter that the Federal Reserve Bank is paying attention to, that they're monitoring, where on one end you have inflation and on the other hand you have the economy. And when I say economy, they're particularly looking at the GDP, the growth of our economy, and they're looking at unemployment numbers. And what they're doing is they're weighing these two things. They're weighing inflation against the economy to decide what they want to do to influence inflation and the economy. So the Federal Reserve Bank is in the business of trying to keep inflation low while trying to keep the economy high. Those are the two things that they want. Well, right now, the economy, according to the Federal Reserve Bank, is high because the GDP, while it is slowing down, it's not that big of a slowdown according to them, and that people have jobs. We're seeing unemployment starting to go up, but the vast majority of people have jobs. So the Federal Reserve Bank says that the economy is good and it's high, while at the same time, inflation is too high for the Federal Reserve Bank. So this gives ammunition or fuel to the Federal Reserve Bank to now continue to fight inflation. See, the downfall for this inflation fight is that this inflation fight hurts the economy. See, the Federal Reserve Bank now is going to try to cool this inflation fight, but that's going to put pressure on the economy to slow down. So it's this teeter-totter act where the Federal Reserve Bank wants to keep the economy high, but they also want inflation to go down. And what they want to do is they want to bring inflation down without hurting the economy. And so it's a balance. And this is where today the Federal Reserve Bank is saying that their number one priority is not the economy. Their number one priority is not the unemployment rate. Their number one priority is not the GDP. Their number one priority is inflation. And they are willing to sacrifice unemployment numbers, and they're willing to sacrifice GDP numbers to bring inflation down. So what does that mean? Well, if they're willing to make these sacrifices to bring inflation down, that means they are willing to break the housing market in order to bring inflation down. How do I know that? Well, how do you bring inflation down? One of the ways that you do that is by raising interest rates. So if you raise interest rates, that indirectly makes borrowing money for a mortgage more expensive. When you make borrowing money for a mortgage more expensive, it makes it less affordable for somebody to go out and buy a home. And when it's less affordable for somebody to buy a home, you have a lower demand for people to go out and buy homes. And now we're in a time where demand is falling to buy a home while supply is starting to rise. This brings us to the basics of Economic 101 with a random guy on YouTube. And when you have falling demand with growing supply, that pushes real estate prices lower. So today, in this environment that we're facing today, and again, I'm saying today because 6 months from now, who knows where we're going to be? Who knows what the Federal Reserve Bank is going to say their goal is then? But today, the Federal Reserve Bank is in the business of bringing inflation down, even if that means raising interest rates to the point where it is willing to break the housing market because they want to break inflation. Now, they're hoping that inflation will break before the housing market, but this is the game that they're playing. Now, why do I keep saying today? Because what happens now if 6 months, 12 months, 18 months down the line, we start to see inflation maybe cool down, but we also see the economy cool down, where now we see unemployment numbers go up. We see the economy slowing down even more. What is the Federal Reserve Bank going to do then? Are they going to continue to stay aggressive to bring inflation down to 2% like they're saying today? Or are they going to say, yeah, inflation has come down since its highs of 9%, but now we need to focus on the economy and we're willing to sacrifice some more inflation in order to stimulate the economy? If they do that, that would cause another boom in the housing market because that means that they would start cutting interest rates again, making it more affordable for somebody to go out and buy a home. So this is the balancing act where we don't know what the Federal Reserve Bank is going to do, but this is where you want to pay attention to what's happening. And if you're planning on buying a home, this is where you don't want to be trying to time the market. Instead, make sure you can afford the home that you're going to buy. Do not get an adjustable rate mortgage. Get a fixed rate mortgage and buy something within your means where you can afford the monthly payments comfortably and you can also afford to move in. You can afford the down payment and you have the ability to take care of the home because many people, once they buy a home, start having regrets because they don't realize how expensive it is to take care of a home. So if you want to buy a home, that's fine. Just make sure you can afford it first. And if you want to stay up to date on what's happening in the economy and the housing market like this, make sure you join Market Briefs. I have the link for you down in the description below.
The job market is still very tight. Yet tech companies are doing layoffs. We are seeing job hires in other areas, but this is the beginning. And so where will it go next is what you want to pay attention to, because kind of like how inflation was just transitory in 2021, we're in a situation today where, hey, this economic slowdown might not be transitory like the Federal Reserve Bank and the government keep saying. It might be a real recession.